Jeff Lewis, Global Market Strategist with JP Morgan Asset Management, joins us live with his take on the current market setup. Jeff, good morning. Thank you for joining us. Jeff, do you think globally some degree of complacency has kicked in? Markets, frankly, currently are not bothered about the kind of economic headlines which are emerging from US and Europe?
Well, I think the political concerns do seem to be taken by the markets more or less in their stride at the moment. They've seen problems between the Republicans and the Democrats. They saw the debt downgrade in 2011. So I think they're seeing this as a repeat, with a certain amount of theatricals thrown in. Probability of a long period of shutdown, which would actually damage the U.S. economy, we still think is a tail scenario. But nevertheless, there are certain risks. So certainly the market is showing a little bit of complacency, I think, and things could get a little tougher over the next couple of weeks.
Jeff, what according to you could be the impact on emerging markets? Because off late we've seen there's a significant rally in the entire emerging market lot post the US government shutdown.
Well, yes, over the last couple of months, the emerging markets have caught up in a bit of a stealth rally, I think. I think they've outperformed the S&P 500 by around about 5%. But of course, we are in a period now where the purchasing manager indices for the four major economies, US, Europe, Japan, and China, are all north of 50 and heading up. And that surely is good news for the emerging markets, which have seen poor export performance over the last 12 months. But a better global economy is very good news for emerging markets, including those in Asia.
Jeff, two concerns which really got emerging markets down were tapering and weakness in local currency. Tapering has been delayed and dollar index has plunged to an 8-week low. So in the short term, do you think it's all clear blue skies for emerging markets?
Well, I think we will see tapering. It's been delayed, but I think the markets will come to understand that tapering is only a baby step towards actual tightening of monetary policy. So I think the worst of the shakeout of the crowded trades we've already seen. And of course, it was more the emerging debt space that was the center of the storm. Looking at equity inflows into India, for example, they've actually been net flat over the third quarter, which is quite a robust result. So I think that the next round of tapering fears will not be anything like as bad as what we saw in June and July.
Jeff, what's the view on the dollar then, considering it's eased off somewhat after the government shutdown?
Well, I think the US dollar is relatively well supported by the fact that the US is much further down the road in terms of deleveraging, and that we believe the economy will be gathering strength in 2014, and we'll see a broader recovery. So the US is further down the road in terms of normalizing its monetary policy, and that should actually support the dollar over the longer term.
Jeff, as of now, emerging markets and developed markets are trading with a downward bias. We've not seen a real impact of the recent economic headlines or the global news flow. Do you think it's a matter of time we will get some kind of an economic headline and then we could be staring at some real selling?
Well, I think for the emerging markets, our advice to investors is they still need to be positioned within the emerging markets because they are very good value currently in terms of price to book. They're at a level from which subsequent returns over, say, a 12 to 18-month period have been very good. The problem is we're still seeing downgrades to 2013 earnings for the emerging markets, and we've had the volatility and the focus on those emerging markets with trade and current account deficits. So I think we have to be selective, and I don't think there's no near-term catalyst, I think, to cause a sharp rally. So it's a question of investors being patient, but these are good long-term entry levels, I believe.
Jeff, leave us with your view on India. What's the call for us?
India, I think it's been in the spotlight as one of the more fragile emerging markets, like South Africa, like Turkey, which do have trade deficits. I don't think it's so much the current account deficit. I think it was due to short-term portfolio outflows. I think that those are now stabilizing, and that the trade and current account deficits on the latest data are starting to improve. So it's going to delay recovery. We've had interest rates raised a little bit. They may have to go up again. So India it's really in limbo at the moment. So I'm not expecting any dramatic improvements, but nor am I expecting any major deterioration from this point. I think a lot of the bad news is already priced into the market.
So is JP Morgan a buyer in India or a seller of Indian equities?
Currently, we are slightly underweight. That's on a tactical basis. So we see better opportunities currently in other Asian markets, but long term we remain positive on the India secular story.
Within India, which way are you leaning? Are you still bending more towards defensives, more towards exporters, or now you're treasure hunting within industrial, cyclicals and metals?
Well, we take a bottom-up approach to investing, but currently we are still overweight materials, overweight consumer discretionary, and the financials, underweight telecoms, underweight defensives.
That's not the consensus call. The consensus call is that Indian economy is suffering, growth will contract, and one should avoid metals and materials. But you are overweight financials and materials. What's the thinking behind this call?
Well, basically, a lot of the bad news is priced in. The economy has reached a trough, and good news on the global economy should actually help to lift cyclical sectors everywhere.
Right, Jeff, really appreciate your time and so glad you could accommodate this interview request.